And now for more on this, I'm joined by Jonathan David Lamb, an oil and natural gas policy analyst. He joins me live from London. Great to have you here with us on TRT World. So oil prices are recovering after a sharp sell-off. So let me ask you, did traders move too quickly or perhaps too aggressively on hopes of easing tensions?
One thing we've seen throughout this conflict is an amazing amount of volatility. Because the difference between peace and war in terms of prices is huge. And I think we've seen overreaction from traders on a number of occasions, and this is probably another one.
And we are seeing a huge intraday swing in crude prices. How do major fuel consumers like airlines, shipping firms, and logistics companies actually manage their operations when they cannot accurately forecast their energy costs from one 24-hour cycle to the next?
Well, in many cases, these large consumers don't pay daily prices. They will have agreements where the prices are calculated over a week or in some cases even a month, and then they will be readjusted. So the suppliers, the refiners, are the ones that are more likely to have to deal with this level of complexity. Of course, it's their core business, so they're used to having strategies for dealing with this kind of thing.
And Jonathan, reports indicate crude storage levels, especially in Asia, are running critically low. So even if a deal is reached soon, could tight inventories still trigger another price spike?
Well, if we reach a deal, I don't think we'll see more price spikes. But I do think the fact we have very low inventories will keep prices relatively high for a number of months, because those inventories will need to be replenished before we can see prices come down very substantially.
And Brent crude remains below the $100 mark, yet fuel prices are at the pump keep rising. So why is there such a delay between oil markets and consumers seeing relief?
Well, very often when there's a very rapid spike, the pricing systems that refiners and also fuel retailers use tend not to be daily. So you can often see if the price of oil goes up to $120 a barrel and then comes back down again, you may never see actually that as a consumer at the pump. But often it goes up and then there's a calculation that's made to cover those extra costs, and that will register with higher prices in the next week or so. So you can never be sure whether you're actually paying the full crude oil price or not when you're buying your fuel.
And Jonathan, no one really knows what's going to happen with the deal, whether or not a breakthrough is going to happen in the next few days or perhaps weeks. So let me ask you, if these tensions drag into summer, where do you see Brent crude heading in the second half of 2026?
Well, I think the painful reality is that if the flows through the Straits of Hormuz do not come back at some point, and I'm not entirely sure what that point is, we will need as a global market to remove something like $7 or $8 million barrels of oil per day from demand. And when I say remove, we need demand destruction. So the oil price will have to go up enough to reduce oil demand by millions of barrels per day. That level is probably well above $200 a barrel. Will we get there? I'm not sure. But that's one of the possibilities if this conflict doesn't come to an end over the next few months.
Fascinating insights. Jonathan Lamb, thanks very much for joining us here on TRT World. I really appreciate your taking out the time.